All rise. The Supreme Court of the State of Colorado is now in session. Chief Justice Coates presiding.
Thank you. Please be seated. Looks like we have two cases on our docket for this morning. First one is styled Department of Revenue versus Agilent Technologies. Looks like you all are situated and ready to go. Counsel for petitioner, you know how to work the machinery. It'll count down. You have to watch your own time and reserve whatever time you want for rebuttal. And go ahead and proceed when you're ready.
Good morning, Chief Justice Coates, Justices. I am Terry Gill, representing the Department of Revenue. With me is Noah Patterson, also representing the Department of Revenue. May it please the Court, the purpose of Colorado's Water's Edge statute, Sections 303(8) and 12C, is to exclude from domestic combined reports predominantly foreign-based corporations, specifically only corporations with 80% or more of their property and payroll can be excluded from a domestic combined report. The question that the Court is being asked today is whether a corporation that has no foreign property and payroll at all should nevertheless be treated the same way as a corporation that has predominantly foreign property and payroll. There are three reasons why the Court should answer no to this question and reverse the Court of Appeals below. First, if you apply the statute as written, Agilent World Trade actually has 100% of property and payroll located in the United States and none overseas. Second, if Agilent World Trade has no property and payroll, the Court, following the legislative intent and avoiding absurd results, has to reach the same conclusion. Agilent World Trade needs to be included in a domestic combined report. And finally, if Agilent World Trade is excluded under the Water's Edge statutes, the legislature has given the department the authority to assign income from Agilent World Trade back to Agilent in order to accurately reflect Agilent's income and avoid abuse. How have we gotten here today? The fundamental flaw, or flaws in the Court of Appeals decision below, is to determine that Agilent World Trade had no property and payroll at all. Second, it failed to properly apply the statute as written. The Court instead determined that because 20% of $0 equals $0, Agilent World Trade had less than 20% of its property and payroll located in the United States. That's an illogical statement. If we give it a slightly different example, let's assume Agilent World Trade had $100 of property and payroll and $10 in the United States. If we multiplied $10 by 20%, we would get $2, a useless piece of information. Instead, the Court should have applied the statute as written. The direct result of excluding Agilent World Trade from the domestic combined return has multiple absurd results. First, we have the obvious problem that a corporation with no foreign presence at all is nevertheless treated as one, treated the same as a company with 80% or more of its property and payroll. Now, that doesn't make any sense. The second is, by excluding holding companies, every holding company in the United States, and there are thousands, maybe hundreds of thousands, are automatically excluded from Colorado's ability to tax them. There are corporations, we've cited multiple cases in our brief where corporations created holding companies and dropped income producing securities, intellectual property, all with the intent of excluding that income from state taxation. And this is all income that would be taxed at the federal level. If this remains the case, any corporation can avoid tax as easy as flipping a light switch. And finally, we have a situation where if the Court of Appeals conclusion is upheld, all of Colorado's mandatory combined reporting rules will be overturned. How does that happen? We have Agilent, who is the domestic parent in California. Agilent World Trade, headquarters in California. It has a series of foreign corporations: Venezuela, Russia, Poland, Turkey. Those are just examples. There are many more. We have the first situation that this is automatically a foreign corporation.
Well, let me ask you about that, Mr. Gill, and good morning to you. Are you not assuming that a company has to have payroll or property, as those terms are defined, somewhere? I mean, isn't the issue here that Agilent's only property are intangibles?
No, Your Honor, we disagree. There's two issues here. One is what kind of property the Agilent has. And if we go to both 12C and 8, they tell us to go to Section 2460.1301 to find out what the definition of property is for the factoring purpose. And they tell us that it includes tangible and real property owned, rented, and used.
And I understand. And I understand fully the argument that you make. They use their headquarters, they use resources. Let's say we disagree with that for argument's sake, or we say that's de minimis. Isn't it true that a company could have no property as defined that way? Its only property would be stock, in which case you would have a holding company that doesn't have property or payroll either in the United States or foreign. It seems to me you're assuming that since everything is foreign and has to be, or nothing is foreign and has to be domestic or vice versa. And I guess I'm questioning that assumption.
Well, that's our second point, Your Honor. And our second point is, if the court concluded that Agilent World Trade had no property and payroll at all, that can lead to an odd result. Not the Court of Appeals decision, but you nevertheless have a situation where Agilent World Trade has zero total property and payroll, and yet its payroll in the United States is also zero. Its property and payroll outside of the United States is zero. What you have is a situation where domestic property is equal to total property. And then again, you have the situation, if you do the factoring, you have to divide zero by zero. And what the mathematicians tell us is that that doesn't have a specific answer. You can prove, using mathematical proofs, that it does have over 20%. The problem is that you can also prove that it has 80% or 19%. So you have a dilemma there. We can prove it, but you can prove an alternative. Here, we need to look at the court's decisions on properly construing a statute, applying the rules of statutory construction. And we can rely on cases such as Avicom versus Public Utilities Commission, U.S. West, and Frazier versus People. In both of those cases, the court was faced with statutes that, if read literally, reached absurd results. They did not make any sense.
Mr. Gill?
Yes.
Good morning. What about your regulation? Don't you have a regulation, 303.12C, I think it is? How does that play into this?
Yes, Your Honor. The regulation, as we stated, was adopted to deal with a specific issue. The intent was to deal with entities called foreign sales corporations. Foreign sales corporations are actually similar to what we have in the Agilent situation. They're required to have foreign offices, foreign directors, and foreign documentation.
Does it say that in the regulation?
The regulation could be interpreted broadly, but But the intent is clear that the focus was on the more narrow interpretation. Since 1985, the Department of Revenue has construed both the statute and then in 1992, the regulation to only exclude foreign-based corporations. That was established and not challenged for over 30 years. It was not until this case that a corporation has decided to challenge that interpretation based on the regulation. One thing we know with the regulation, though, is that if the court were to extend it beyond foreign-based corporations, it would be conflicting with the statute as written, and it would be conflicting with the clear legislative intent to exclude foreign-based corporations. We know that from the statute itself. We also know it from the legislative record, and we also know it from the basic history of the 80-20 water's edge concept.
Can I ask you about the statute, Mr. Gill? And I'd like to focus just on the language. And I've been struggling with how to piece this all together, as I think all of you have too. So I want to float something to you and get your reaction. You have made the argument that 12C and 8 are kind of reciprocals or the opposite sides of the coin. I'm questioning whether that's right, and I want you to push back. It seems to me you start with 11, subsection 11, which says the director can require an affiliated group to file a combined return. Affiliated group is defined as having a chain of includable corporations, and includable corporations is defined as more than 20% domestic. I'm simplifying. If it seems to me, at least arguably, Agilent is an affiliated group here because it has at least 2 includable corporations in it. That makes it affiliated. That requires the combined return, but you only have to include companies that meet the three of the 6 factors. With me so far?
I am indeed.
Okay. And so it would seem to me if that and I want to know if that reading makes sense. It doesn't say, 11 or 12 doesn't say you must include an includable corporation. It says an includable corporation you look at to figure out if you have an affiliated company. And then, so I think this could play out, and I really do want you to tell me why this is wrong. We have Agilent is an affiliated group here. So the director can require a combined return, but it only has to include a company if 3 of 6 are met. You say 3 of 6 are met here. Then we have to look at 8. Is that not how this statute all fits together?
Well, Your Honor, it is with the following exceptions. You do have this group, Agilent, World Trade, and Agilent, are an affiliated group. They meet the 3 of 6 tests, and they, in fact, satisfy the control aspect of 303. The problem is that once you determine that it's not an includable C corporation, it breaks the chain of includable C corporations. In order to be included, you have to be a member of an unbroken chain of includable C corporations. So by definition, Agilent World Trade is no longer includable, no longer part of an includable chain. The net result of that is that not only is Agilent World Trade excluded, all of its subsidiaries are excluded as well. Now, our situation, we have a situation where these are foreign entities, and no one's claiming that these are all excludable entities. No one's claiming otherwise. But if we change the facts just slightly, let's change these foreign entities into domestic entities. Instead, we have Vermont, Rhode Island, Pennsylvania, and Texas. We have an entirely domestic set of corporations here. And they would ordinarily be part and included in a domestic combined report. But because of the Court of Appeals' decision to treat Agilent World Trade as if it were foreign, all of these, the entire domestic corporation, is excluded. Now, this is contrary, directly contrary to the overall statute's intent, the legislative intent, that domestic unitary corporations be included in a combined report. So if we stick with this determination, this exception to combined reporting actually eliminates combined reporting, which directly contradicts the legislative intent. and is obviously an absurd result. And on that basis, we have to look to the intent of the legislature, and we have to look to the absurd results that can be avoided. And here, if we're going to avoid those absurd results, we have to look to the overall purpose of the statute. The purpose of the statute, well, go ahead, I'm sorry.
Did you have one? Well, before you turn to the legislative history and the purpose, can you tell me if there's anything that defines the word chain? Includable C corporation, as I recall, is defined under 12C, and it uses, the word chain is used, but I don't recall seeing it defined anywhere to support the way in which you just defined it.
Well, I don't believe it's defined in statute. The way we've interpreted it, and basically consistently throughout from 1985 on, is that you had to be in a series, a chain. And so that chain has to be a affiliated member, or you had to actually be in a chain of includable C corporations. So,
If I can just follow up on that, but Agilent has a whole bunch of, the parent has a whole bunch of chains.
yes.
It just says, to be affiliated, it has to have one or more chains. So it may break this chain on your chart, Agilent, World Trade, and the subs, but there are other chains. So that makes it an affiliated group, and then the question is who has to be included? Why is that wrong?
No, Your Honor, we think that's correct, is that there can well be multiple chains, and each chain then has to be viewed on its own to determine whether that is an unbroken chain of includable C corporations. But the answer is going to be the same if there's one chain or 10 chains. Each chain has to be dealt with on its own, and in this case, Agilent uses a holding company to own all of its foreign corporations. And so this situation, regardless of how the other chains might work, whether they include domestic corporations, whether there are holding companies at all, this one is the one that we need to focus on, and nevertheless, that by definition will exclude a mandatory combined reporting if you have a holding company either pre-existing as here or added at some subsequent time. You can opt out of unitary combined reporting, which is not the intent of the statute and creates the absurd result.
Sorry, may I ask? So it seems to me that and I read the statute slightly differently than Justice Gabriel. I think all we really need to look at for purposes of this problem is 11 and 12C. That 11 says affiliated groups may be required to file together, and an affiliated group is made up of includable corporations, and an includable corporation is any corporation which has more than 20% of property and payroll in the United States. Agilent World Trade doesn't have more than 20% of its property and payroll in the United States because it has no property and payroll. So it's not includable. We're done. In the situation that you're describing, if Agilent, instead of we're talking about foreign companies, the Agilent inserted a holding company and said, well, because we have a holding company in between Agilent and our Pennsylvania, Delaware, and Vermont companies, we don't want to include any of the income from those companies. In that context, one could turn to 6 and say, you can't use the foreign source income statute rules to try to avoid the Department of Revenue taxing domestic source income. So that the problem that you're describing, the absurd result that you're describing, isn't absurd, or the absurdity can be resolved by the statute. What would you say to that?
Well, we agree with that as well. I mean, we have 3 arguments. One is apply the statute as written. We have property and payroll in the U.S. Second is follow the legislative intent. And third is that we have the authority under 303(6) to assign income from Agilent World Trade back to Agilent. If it's not reflecting the economic reality of the situation, if in fact, when you look at all the facts and circumstances of the case, the income should be attributed to Agilent, and not to Agilent World Trade. And we agree with you, Your Honor, that if we have a situation where technically a entity like Agilent World Trade is excluded, you can nevertheless apply separate reporting requirements of 3036 to move that income back. We agree entirely. And in fact, this situation has been addressed in multiple courts throughout the country of corporations creating holding companies and dropping their assets, income-producing assets, in their holding companies. These are companies without property, without payroll, without a separate business, without employees, very similar to what we have here. And simply by dropping an income-producing asset and moving it to another state, they're entitled to avoid taxation on a tremendous part of their income. That's exactly what we have here. What we've cited cases like Gore Enterprises, TD Bank North, Sill, Classic Chicago, every single one of those cases address the very same issue here. Gore Enterprises, the company, dropped income-producing securities into a holding company. That court determined that that didn't reflect the economic reality of the situation because that entity didn't do anything. And so therefore, under provisions of looking at the economic reality, that had to be attributed to the parent.
What do you mean? I'm sorry to interrupt you again, Mr. Gill. So on TD Bank North, the court expressly found that the holding company had no non-tax business purpose and lacked economic substance. It seemed, if I remember right, and I may be confusing the Oracle case in this one, if I am, I apologize. There's testimony from your side. Experts say there's no abuse here. Holding companies are common. I mean, it seems there is an economic reality here. So help me understand I don't know, maybe you're not arguing abuse, you're arguing clearly reflect income, or maybe you're arguing both. But help me understand, where's the abuse here that requires 6 to apply?
The abuse focuses on the result of the transaction or the structure. And abuse does not require some kind of intent to evade taxes. And in fact, 3036 doesn't say that. Abuse doesn't necessarily mean that. This court has interpreted 3036 in Joslin Dry Goods not to require intent. It simply has to focus on is the method being adopted by the Department of Revenue one that avoids abuse. That is, avoids the problem of income not being properly recognized among the unitary group. Currently, both parties agree that arm's length pricing regulation is part of 3036. Arm's length pricing simply says that when Agilent sells its goods to its foreign subsidiaries, it has to do so at fair market value. If it does so at less than fair market value, it's artificially reducing its domestic income, increasing its foreign income. But the test is not intent to evade taxes. The test is it fair market value? So 3036 has never required some kind of intentional evasion requirement. It simply needs to reflect what's the true economic situation here. Now, your point, Justice Gabriel, about does a holding company lack economic substance? Holding companies can and cannot, depending on the situation. But if you have here that in this situation, this entity doesn't actually do anything. This income travels from foreign subsidiaries to world trade and instantaneously goes to Agilent, the parent. The Agilent gets all of this income, and it's taxed at the federal level. But because of treating this entity as a foreign entity, somehow it's no longer taxed. And that's the lack of economic reality that these cases have all addressed and should be applied here. There really is no purpose. It has been claimed by Agilent that, well, its purpose is to impose limited liability. But if that were the case, there would be no economic substance doctrine at all, because every corporation has some level of limiting liability. There has to be something more to the economic substance doctrine, which we incorporated in 3036. And 3036 we see as a broader authority to look at separate corporations to determine whether income is improperly assigned to a shell entity. And this is precisely the facts of the Gore case, and precisely the facts of the Bank North case, dropping income-producing securities into a holding company and thereby eliminating all state taxation.
Could I ask you, just to follow up on your abuse, I'm still having a little trouble what the standard would be then for abuse. Maybe I'm hearing too broadly, but when you use terms like inappropriate, avoiding, but not an intent to evade taxes, would you treat as abuse any structuring of one's business arrangements that would be most favorable to the company in light of the statutory provisions?
We would not, Your Honor. I think that what we refer to in 3036 is that you can incorporate doctrines like economic substance. Economic substance has been interpreted by states, including the cases that we cite, and in the federal government, to have lots of rules that restrict its use. And both the U.S. Supreme Court and courts throughout the country, if not this court, have applied that standard to transactions. And it's not an open-ended requirement. It's a sense of looking at the facts and circumstances and determining whether a particular transaction lacks economic substance or does not represent the economic reality of the corporation. So there is substantial case law determining whether to apply that rule and thus Section 3036.
But doesn't that doctrine, the common law version of it, incorporate an intent to evade or escape or minimize taxation?
We disagree, Your Honor, particularly in the state law context where we're talking about combined reporting and the Commerce Clause limitations. If you look at the Bank North case, the Gore case, the classics of the Chicago case, all determined that, and many federal court cases state that while intent may be considered, it is not required. It is not necessary. So those courts, like the Colorado court interpreting 3036, have not required intent. They have required perhaps a showing of lack of economic reality, economic substance, or that whatever the relationship between the two entities does not properly reflect the income of Agilent itself. So we disagree that there is an intent requirement. The previous provision did include language to evade taxes. The new, in 3036, adopted in 1985, the language was changed to avoid abuse. And the abuse that we're focusing on is relying on shell entities that have no separate business of themselves to avoid combination, not necessarily taxation, but combination in a combined report.
Mr. Gill, can I ask you about Section 6, if I can follow up on the couple of questions that were just asked? I guess my concern has to do with who decides economic substance, and I know you talk about that. Obviously, the government decides that, and then you said there are rules and there are standards, but it sounds like it's just sort of whenever you think it applies, that it would apply. So how would you respond to those concerns that application of subsection 6 here could prove to be sort of a slippery slope that can, in the end, swallow some of the other subsections?
Well, I think, again, the important distinction is 3036 is not a combined reporting statute. That's clear that that aspect of accounting, tax accounting, has been replaced by 30311 and 12. What 3036 focuses on is separate accounting, the relationship between non-combined entities. And in that kind of accounting, you do recognize things like lack of economic substance. the federal courts and the state courts have not broadly interpreted economic substance. What they have looked at is situations where, like the holding company structure, that all that has been done to exclude income from Agilent is to spend $35 at the Colorado Secretary of State to create a holding company and a couple of hours of paralegals' time to create some minutes. That is it. And all that has been done is taking Agilent's income-producing properties and separated them into that shell entity. In these kinds of situations, where there's absolutely no business going on in this entity, no employees, no nothing, the courts have universally held that that lacks economic substance. It lacks economic reality. This is an easy case. I agree with you, Justice Samore, that there are harder cases to deal with, and the court would be more challenged in when we have a situation with employees, with a separate business, with separate income-producing activities. But Agilent World Trade has no income-producing activities. It doesn't do anything but hold Agilent's securities, which if Agilent owned them themselves, would be fully taxable, the income from those securities.
Counsel, I think your time has run on you.
Oh, my goodness. Thank you, Your Honors.
Thank you. We appreciate it. Counsel for respondents. Is it going to be significant that one chart is vertical and the other is horizontal? I'm sorry, proceed.
Thank you, Chief Justice Coates, and may it please the court. My name is Erwin Slumka of the firm of Morrison and Foerster. My New York bar number is 1692862. I am admitted pro hac vice in this case. My co-counsel are Neil Pomerantz of the firm of Silverstein and Pomerantz, and Craig Fields of the firm of Morrison and Foerster. In 1985, the Colorado legislature fundamentally changed the Colorado combined reporting regime with comprehensive changes to Section 303. Now, there were two purposes for these changes. One was to limit the broad and very uncertain reach of the former statute that authorized worldwide unitary combinations, so that's clear. But it also did another thing. It was intended to create bright line tests for businesses to know how to structure their affairs, because that was the concern for many years leading up to the 1985 legislative changes, and the 1985 legislation tried to address that comprehensively. Now, I consider this a very unusual case in my experience. It's a rare instance where a legislative body, in this case the General Assembly, having enacted Section 303.12c just a few years earlier, came back later, took a look at what the department was doing, and made clear exactly what the legislature intended with that 1985 legislation by rejecting a regulation which said that corporations with no property and payroll are always includable C corporations. Now, 28 years later, the department once again is attempting to take a similar position, this time by appealing to this court. Section 303.12c is clear on its face. It states that a corporation with more than 20% of its property or payroll in the U.S. is an includable C corporation and is subject to combination if Section 303.11 applies. In the case of a holding company, the department's own regulation is absolutely clear on its face, and it deals specifically with a holding company with no property or payroll of its own. And it says it cannot, by definition, be an includable C corporation, so you don't get to 303.11 because it can't even be included.
Can I ask you, Mr. Slomkin, good morning to you. I badgered Mr. Gill with my theory of how to read this together. I'd be interested in I won't repeat it all, but would it be interested in your take and how I at least floated how 11 might be read?
Well, I mean, we start with whether or not World Trade is an includable C corporation. Then we look to.
Well, why do you start that way? And this is a discussion, I'm not cross-examining you here. Why don't you start with the first question is, do we have an affiliated group? We have an affiliated group if we have chains of includable corporations. We clearly do here. And then you have to decide who gets included, and 11 says if the 3 of 6 factors are met.
Right. Yes, but a chain of corporations does have to have an includable C corporation.
Right.
Right.
And so maybe we're looking at a train other than the one that World Trade is in. Clearly, Agilent has multiple chains of includable corporations.
Right, but the chain of corporations here that the department is seeking to combine through World Trade does involve a chain in which you have Agilent, World Trade, and then you have below it, you have various subsidiaries of Agilent World Trade. That is the chain of corporations that we're talking about. Frankly, the statute doesn't have to have talked about chains of includable C corporations. The statute could have said if Agilent is unitary with its foreign affiliates, it doesn't matter. You can combine without that a chain of affiliated corporations. The statute does not say that.
But the statute also doesn't say you must include all includable corporations. 11 doesn't say that.
That's correct.
Okay.
Yeah, that is correct.
And that seemed to me what you were saying when you start with 12C. If it's includable, that's the first question. And I guess what I'm asking is, why isn't the first question, do we have an affiliated group? Then the second question is, who meets the 3 of 6 factors?
Well, it's interesting. I mean,
And I may be dead wrong. I apologize, but I'm trying to figure it out.
yeah. I mean, it's a fair question. I think that the way many practitioners have looked at it is that you determine first which is an includable C corporation, then you look to whether it fits into the criteria set out in Section 311 with respect to a chain of includable C corporations.
Is the issue that you can't answer the question whether you have an affiliated group until you've determined what corporations are includable, because only includable corporations can be part of an affiliated group?
You need an includable C corporation in that chain of corporations in order to combine.
Right, so you have to define what's includable first, because you can't answer the affiliated group question until you know what's includable.
Yes. To the extent there's any ambiguity with respect to Section 303.12c with regard to holding companies, as I mentioned before, this is an extraordinary situation where the General Assembly itself enacted legislation which made clear exactly what the legislature intended in 1985. It did so when it rejected a department regulation which said exactly the opposite of what the regulation is that currently exists. A regulation that said a corporation with no property or payroll of its own is always an includable C corporation. The legislature passed a law that said that regulation could not continue. That regulation expired in 1991. The department proceeded to promulgate a regulation consistent with that legislation in 1994, which was exactly the opposite. It's the regulation in place for this case, and it's in effect today. And the regulation does reflect the legislature's actions that it took with respect to Section 303.12c. Now, the department makes two essential arguments on why it doesn't have to be bound by these results. First, it claims that Section 303.6, an anti-abuse provision, allows it to allocate all of World Trade's income to Agilent. And whatever you say about whether it is something other than combination, I think it's obvious that that is exactly what the department is using it for, attempting to use it for in this case, which is contrary to what its own regulation says, which is that 3036 as a result of the 1985 legislation, has been superseded as a vehicle for combined reporting. The department cannot do indirectly what its own regulation says it cannot do directly. But there's no abuse here, and I will acknowledge that in general, the term abuse has been the subject of much debate over the years, both for federal tax purposes, but also, for state tax purposes. But the department's own witnesses testified at deposition that they could identify no abuse with respect to Agilent. They testified that World Trade was not set up to avoid Colorado tax. The district court made factual findings that said World Trade was not put in place to avoid Colorado tax and served bona fide, non-tax-related business purposes in limiting liability with respect to corporations that were doing business throughout the world in countries like Venezuela and Turkey and Russia. So there's no question that there was a bona fide business purpose here, and there's no factual issue that Agilent inserted World Trade in order to reduce its Colorado tax. In addition, the legislative history to the 1989 revisions to 3036, which added the terms "to avoid abuse," makes clear that, and there's testimony in this, that the goal was to go after, quote, the bad guys, the people who were intentionally trying to game the system. Finally, it is not an abuse. It is not an abuse if a taxpayer takes exactly the same position that a department's regulation in place now for more than almost 25 years explicitly allows. And permitting the department to use 3036 as the department seeks to do here because it doesn't like the result, contrary to its own regulation, renders these bright line rules that have been in place since 1985 meaningless and with no standard for what constitutes an abuse. That cannot be the right answer. The department asserts that under the factoring statute that indeed World Trade has property. There's no question that World Trade has no tangible property and no payroll. The reason the department's argument fails, reasons are twofold. Number one, 12C, which defines an includable C corp, is as a corporation with more than 20% of its property and payroll in the United States. The Department of Revenue has consistently said that they believe they should be able to attribute Agilent's property, its printers and computers, to World Trade. They have not asserted that they can attribute or that they have the authority under the factoring regulations to attribute payroll. That alone should be dispositive of the department's factoring argument. But more so, the lower court here noted in the record that there's no evidence of how World Trade actually used Agilent's property and how it had any possession, any control over that property. The department is confusing the fact that Agilent, the parent, may very well have provided certain services to World Trade. After all, World Trade had no property and payroll of its own. But that doesn't mean that World Trade was using the property of Agilent. If I hire a contractor to work on my house, the hammers and screwdrivers of my contractor are not being used by me. The contractor is using them to perform a service for me, and that's exactly what's happened here. But Agilent has raised two other independent grounds, not discussed by counsel here, for why World Trade cannot be combined, and I'd like to discuss those as well. First, World Trade cannot be combined because Colorado law does require conformity with the federal check-the-box elections that were made by certain of the subsidiaries of World Trade. And therefore, World Trade, in the alternative, qualifies as an 80-20 company under 303C. I think the clearest way to show this is to explain to you what a check-the-box election actually does. First, and this demonstrative, I think, will help in this regard, it causes the electing subsidiaries to be treated as having liquidated and become divisions of the owner of those entities. And as a result, for tax purposes, these electing entities no longer exist. They are divisions of the owner, and all of their income and all of their activities, including their property and payroll, in this case, the property and payroll of Venezuela Corporation, Russian, Polish, and Turkish Corporation, all become the property and payroll of Agilent World Trade. If Agilent World Trade does not make a check-the-box election, that does not happen. They are considered separate entities from Agilent World Trade. But here, these four foreign entities did make check-the-box elections for federal purposes. As a result, they are considered to be part of World Trade for tax purposes, one corporation. Why does that matter for Colorado? That is because Colorado law defines a corporation, a C corporation, as an organization that's taxed as a corporation for federal tax purposes. Well, for federal tax purposes, these elections having been made means that this group is being taxed as one corporation for federal income tax purposes. That's one reason why the Colorado Department of Revenue should be required to follow the check-the-box elections. But the demonstrative also shows another consequence of these federal check-the-box elections, and that is this. It affects Agilent World Trade's federal taxable income. So what happens? In the first example, if the check-the-box elections hadn't been made, Agilent World Trade has $100 of its own federal taxable income. The four non-electing under this hypothetical, and these are numbers, these are hypothetical numbers, these are not actual numbers. The four entities below have their own income. Their income is not included in the federal taxable income of Agilent World Trade. So now what happens? As a result of these check-the-box elections, with the property and payroll and the income and expenses of these entities now being part of World Trade, what happens to World Trade's federal taxable income? It has changed. It was $100 if there had been no check-the-box election. As a result of those check-the-box elections, it has now become $120. The $100 that World Trade had on its own, plus the income, and in this hypothetical example, the loss of the one company, all are netted, and as a result, for federal purposes, World Trade now has $120 of federal taxable income. Now, why is that important? It's important because Colorado law provides that the net income of a corporation subject to tax means the C corporation's federal taxable income as defined under the Internal Revenue Code. This means that there must be conformity for federal purposes with federal taxable income numbers. The $100 is not conformity. The $120 under this example is conformity. These two statutes we submit require that the department conform to these federal check-the-box elections. And I'll add one last thing to this point. Virtually every state does. Virtually every state does. If the
Mr. Slomka, can I ask a question based on that? Where were state income taxes paid on the four subsidiaries? Were they paid anywhere? Was there any state income tax paid, or are they being double taxed if Colorado collects?
The answer is it depends on the state. So in some states that don't have, for example, 80-20 statutes, if World Trade was part of the combined return in that state, this income would have been taxed in those states. So I think it's a state-by-state determination. It depends if World Trade is taxable. If World Trade is taxable in that state, either directly or because it was combined with Agilent, then that income is certainly being taxed.
By the state. But in this case, were they taxed?
In
Any state?
In real life, not in the hypothetical.
Right, were they taxed
Well,
somewhere?
there's, this is a summary determination motion. There's no evidence of which states they would be taxed. However, not every state has most states do not have 80/20 company statutes, and I think it is fair to assume that there was tax on some part of the income from these entities. But that the answer to your question is no. There is no record regarding how much tax was paid with respect to that income in any other states. Finally, there is another alternative argument under which Agilent can prevail and world trade should not be combined. And that deals with, we go back to the statute that the court has raised regarding the 3 of 6 factors test. That's under 30311. The only issue regarding those 3 factors is whether or not Agilent's trademarks are being used by Agilent World Trade. And the use that is being asserted by the department is that the Agilent World Trade name appears in or the Agilent name appears in the legal name of Agilent World Trade.
Well, don't
That
they
is the
say,
essence of their argument.
excuse me, don't they say more than that? I mean, I think their argument is there's substantial goodwill to the Agilent name. They relied on it. Getting ahead of ourselves, in the Oracle case, which we're going to hear about, they get $1 billion loan based on their name. So they use the goodwill. And in this case, Agilent excluded another company from using the name. They enforced the mark. How is that not substantial use?
There's not substantial use because we're dealing with a trademark, a creature of law. The law, the trademark law, whether it's federal or in this case Colorado law, defines what a trademark does. Remember, a trademark represents the value of goods and services. Being a creature of federal and state trademark law, it defines that use. And it's those laws that it is appropriate to look to determine how, under the 3 of 6 factors, those trademarks are going to be used. To apply a common dictionary definition, as the department seeks to claim, is not appropriate when you're dealing with a legal concept known as a trademark. I mean, look at Colorado law. Colorado law states that a word name or symbol, a trademark is a word, trait, or symbol used to identify and distinguish the owner's goods or services from others. So if a trademark is not being used to distinguish goods or services, then how can it be used? World Trade provides no goods or services. It did not use, let alone substantially use, Agilent's trademarks, regardless of the appearance of the name in, for example, a tax filing or in a tax registration, or when World Trade had to sell one of its subsidiaries. World Trade was not providing a good and it was not providing a service, and we submit that that is the criteria that is appropriate to use, not a Merriam-Webster dictionary definition of use in the abstract. Frankly, Agilent World Trade didn't have to be called Agilent World Trade. It could have been ABC World Trade.
But it was called Agilent, and it excluded another company from using the name. I mean, it took action to enforce the mark.
Right. Yes, Your Honor, but it enforces its mark when its mark is being used for commercial purposes. There's no evidence of World Trade using that mark for commercial purposes. The sale of its subsidiaries, we submit, is not a commercial purpose. And frankly, nor is the borrowing of money. That is not the provision of goods and services.
I guess the question is, why do we necessarily import trademark law into tax law here for purposes of determining this includable corporation?
First of all, the Colorado statute, the 3 of 6 factor statute, doesn't define use. It lists various types of intellectual property, patents and copyrights and trademarks. It doesn't define use. It actually uses the term substantial use, which frankly is not a term itself in trademark law. But the term use is. There has to be a reasonable standard for how you determine use for these various types of legislatively created creatures, these assets. And it is completely reasonable, we submit, for the department to be required to look to the trademark law to determine how it is used. Again, if it's not used for purposes of the provision of goods and services, we frankly don't understand how it's being used at all. So yes, the statute doesn't use the words that it has to be used and consistent with, for example, the Lanham Act. But the nature of the asset requires we submit that you do, that the department does, just that as the use of a copyright, you would look to copyright law. And so that is, we think, the most appropriate definition of use for this purpose. The factors in the other 6 factors in the 3 of 6 factors test under Section 11, the other 5 all are indicative of true integration of businesses, the performance of services, significantly overlapping directors and officers. These are true indicia of the types of, close relationships between companies. The placing of a name in an affiliate's name is not. It is really a mechanical, non-substantive action that for a company that wants to go out and borrow money because the name Agilent appears in its name. I think it's incorrect to think that is why a lender would lend a company like Agilent World Trade funds. I think it is because the parent would guarantee that loan. I think it's because the financials of World Trades justify the loan. I do not believe that it would be because the name Agilent Technologies appears in the Agilent World Trade name. The World Trade does not use these trademarks of Agilent any more than Agilent is using its own trademarks in these court pleadings, or the department is putting Agilent's name into its court pleadings. In sum, the department is arguing for a common definition, a common dictionary definition here of the word use, but there is no common dictionary definition of the word use when it comes to a trademark. The only use of a trademark, we maintain, is what trademark law provides, and that, we submit, is what should govern here in interpreting Section 303.11.
Mr. Slomka, can I follow up on that? If with a company with no real payroll or employees or whatever, how could they use the trademark more? I mean, what would be an example of substantial use of a trademark by a company like Agilent World?
At Agilent World Trade, by not providing goods and services to anybody, it's simply a holding company to hold foreign operating subsidiaries.
I understand. I'm asking, is it impossible for a company like that to substantially use the parent company's trademark?
I would say the answer to that question is yes. It is impossible for them to substantially use the trademarks if it doesn't act in the public domain in providing goods and services. It just can't be done.
Mr. Slomka, let me take you back to the discussion we had earlier. You assert that World Trade has no personnel, no property, correct?
Yes.
But as a result of World Trade, Agilent stands to save a lot of tax money here, correct?
Under the Colorado statute and our interpretation of the statute, the answer is yes.
Do you think that this is what the General Assembly envisioned?
It's hard to say what the General Assembly was thinking at the time that it enacted the 1985 legislation. It is not, we can't at this point know everything that was being contemplated. But we do know that the legislature was thinking about holding companies in some way, again, because in 1991, they looked directly at the department's former interpretation of a regulation under 12C and said, that is not supported. A holding company that doesn't have property and payroll cannot be, it said, an includable C corporation. Whether or not the legislature was contemplating the tax consequences of that action, is not clear from the legislative history. But I think it is clear that the legislature in 1991 did believe that there was no support for that regulation. The Department of Revenue at the time, acknowledging what that legislative intent was, then changed its regulation to the regulation that is in place now. That regulation is clear, and that regulation prohibits the department from doing exactly what it's attempting to do in this case. Well, thank you. Thank you.
Thank you for your argument. The court would like to thank both counsel for their arguments. Case is going to stand submitted, and the court will be in recess for 15 minutes.
Court is in recess. is in session.
Thank you. Please be seated. Second case on our docket this morning, as I walked in, I was getting a sense of deja vu. The Style Department of Revenue versus Oracle Corporation. Now I can tell council really look like they're ready. Petitioner, when you're ready, how about beginning?
Thank you, Chief Justice Coates. May it please the court. My name is Noah Patterson, and along with my co-counsel, Terry Gill, I represent the Colorado Department of Revenue. Like the Agilent case, this case will determine more than the taxation of the $6.4 billion at issue. This case will also determine whether combined reporting will remain mandatory as intended or will become optional for Colorado's corporate taxpayers. If Oracle's statutory interpretation is adopted, Colorado's corporate taxpayers will be able to choose how much income they want Colorado to tax simply by placing their profitable subsidiaries in holding companies or by relying on already existing holding companies. Now, the statutory interpretation that the department asked this court to adopt is that at a minimum, a corporation must have foreign property or payroll in order to even be considered for exclusion under the Water's Edge statute. There are three bases for this interpretation. First, the history and the text of the Water's Edge statute. Second, the absurd results doctrine. And third, subsection 6. But before I get to those points, I'd first like to briefly discuss the importance of combined reporting. Combined reporting is important to Colorado, first of all, because it applies tax based on economic reality. Combined reporting allows Colorado to look at the entire income of an integrated business and determine which part of that income should be apportioned to Colorado for taxation. This court stated in the Hewlett-Packard case that transactions between corporations under common control may lack economic substance. Therefore, it is necessary to look at the corporate group as a whole. Another reason why combined reporting is important is that it allows Colorado to tax on a fair and equal basis. Combined reporting allows Colorado to tax a corporation like Oracle that operates its business through subsidiaries in the same way that Colorado taxes another business that operates as one entity and uses internal divisions instead of subsidiaries. As this court also stated in the Hewlett-Packard case, there is no reason to find different results based simply on different formal business structures.
Mr. Patterson, can I ask, in the last argument, Mr. Gill said that this is the first time this has been an issue. Does that mean that since 1985, a company set up like Oracle with a holding company subsidiary that has no property or payroll, that holding company subsidiary has been combined? That has been happening for 34 years?
Yes, Your Honor. Yes. And before I get into my main points, I'd also like to address a question that Justice Boatwright asked in the last argument, which was, is there any danger of double taxation here? And the answer is no. Combined reporting in Colorado and in other states is set up through a process called apportionment. And the apportionment process is specifically designed to prevent double taxation. Each state looks at the business activity of the business in that state, which includes property, payroll, and sales during our years at issue, and then apportions a part of that income to the state based on that business activity. So there is no danger of double taxation. And to answer another question from the last argument, in this case, based on the record that we have, Oracle has included Oracle Holding in every other combined reporting state. That's based on page 825 of the record. Based on what we have, the information that we have, every other combined reporting state has included Oracle Holding. So to affirm the court below would actually make Colorado an outlier among all combined reporting and water's edge states.
But doesn't that depend on what the state statute says?
Yes, Your Honor, and that actually leads in, I think, to the next point, which is how Colorado statute fits within the greater history, both in Colorado and nationwide, as a water's edge statute. So in the early 1980s, there were 12 states that required corporations to file combined reporting returns on a worldwide basis. But there was a lot of pressure from foreign countries and multinational companies to abandon that practice. So in 1983, the federal government convened a working group that was specifically designed to address the issue of worldwide combined reporting. That working group came at the water's edge, or the 80-20 solution. And that solution was specifically designed to avoid the problem that we have in this case. In the report of that working group, which is cited in the MTC's amicus brief, it said that the 80-20 approach would guard against the use of paper or shell companies to avoid state taxes. So it was specifically designed to address the issue we have here. It was only designed to exclude predominantly foreign corporations, not wholly domestic ones. And the history in Colorado reflects that same purpose.
Well, what in the statute supports the argument? I understand the history that you're making. Give me your statutory analysis for the argument that every domestic corporation, regardless, must be included in a combined return.
Yes, Your Honor. So 8 and 12C have a defining characteristic. They both require percentages. 8 requires a percentage to be excluded. 12C requires a percentage to be included. Percentages are parts of a whole.
Well, help me with that. Sorry to interrupt you, but this is going back to what I asked Mr. Gill before. Tell me what argument says, when you read 11 and 12 together, that it has to be included in the combined return. 11 seems to define what needs to be included based on the 3 of 6 factors, not if it's an includable corporation.
Yes, Your Honor, but to even get to the 3 of 6 factors, and I guess this goes back to your question in the previous argument, which is how do 8, 11, and 12 all work together.
Right.
And the way that the department applies these statutes in its audits and elsewhere is that it first applies 8 and 12C because you first have to know which companies are water's edge companies in order to know which companies are going to be excluded, first of all, from the affiliated group. Then you go to 12, you figure out what the affiliated group is. Oftentimes that's based on the federal, there's a federal affiliated group for corporate consolidated returns. That's the starting point usually for 12. And then you determine, once you determine what the affiliated group is, then you last move to the 3 of 6 test in 11 and apply those only to the companies which are part of the affiliated group, and those must be chains of includable C corporations. Moving back before we get to the text again, specifically in Colorado, when the General Assembly adopted subsections 8 and 12C, they specifically said that it was intended to exclude only predominantly foreign corporations. Senator Wells, who was a sponsor of the 1985 bill, said that the bill would exclude corporations with more than 80% of their operations outside the United States. Senator Wells also stated that the unitary method would continue to be applied within the 50 domestic United States. And that's reflected in the text. As I started saying before, the defining characteristic of those statutes are percentages. In order for there to be anything less than 20% of property and payroll inside the United States, you must have property and payroll outside the United States.
Or have no property and payroll.
So we disagree with that, Your Honor, in that we think that if you have no property or payroll, it's an indeterminate result. And so you're neither have property inside or outside. I think that the focus from the court below on no property or payroll is the wrong focus for the statute. It's focusing on the amount, whereas the statute focuses on proportion. It's saying, we're looking at the proportion of the business both inside and outside the U.S. And a business cannot operate nowhere. Corporations don't exist in the ether. Corporations must have a physical presence and must have a location. Oracle.
But the state of incorporation might be you could have 0 property and payroll and be a Delaware corporation.
Not under our statutes, Your Honor. So the Court of Appeals below stopped its analysis at 8 and 12C. The analysis cannot stop there. That was an error the court made.
I'm just, so even the department acknowledges that Regulation 303C is referring to some kinds of corporations, right? So you can be a corporation with no property or payroll.
We're not sure. Now, so I think that when a corporation is earning income, it has to have property or payroll to earn that income. You can't earn $6.4 billion and have no operations at all. And as I will get to later on, that's because you're using property and payroll that's owned by Oracle. But now I think there are probably some corporations that maybe don't earn income that may have no property or payroll. But under our statutes as they are written, it's different than just owning. You're not just owning property or payroll. If you're using it at no charge, you also have property. You also have property for purposes of the statute. And that's because when you go to 2460-1301, as our statute requires, it defines property as real and tangible personal property owned or rented and used. And our regulation under that statute, Regulation 4.18b2, explains that property used at no charge is included in the calculation.
So if Oracle Oracle Holding used one paperclip from Oracle, under your analysis, 100% of its property is domestic. Isn't that absurd?
No, Your Honor, and that's because of if the statute had required a specific amount of property for inclusion in the U.S., I think we'd have a different answer, but instead it requires percentages. And
Sure, so am I right? If they used literally one paperclip, then under your view, they're domestic under the statute because 100% of its property is domestic.
Yes, Your Honor. But that said, I think it would be very unlikely that a corporation would simply use one paperclip if it's earning significant income. And that's not the case we have here because we have Oracle Holding. So I guess to step back for a second, the court below and Oracle have never argued that the department's regulation 4.18b2 is inconsistent with statute or it's unreasonable. Instead, what Oracle and the court below found was that Oracle Holding does not use Oracle's property. But that's contradicted by the record. If you look at starting at page 1335 of the suppressed record, you see a series of loan documents and where Oracle Holding loaned $6.4 billion to Oracle's treasury subsidiary. In each of those documents, Oracle Holding used Oracle's California headquarters to complete those loans. Its officers and directors used equipment and property to complete this large transaction. If you look at page 61 of the suppressed record, Oracle Holding stores all of its corporate governance files at Oracle's California headquarters. Also on page 61 of the suppressed record, it says that Oracle Holding, its officers and directors use Oracle, the parent's system, to document every action that that board takes. And finally, this is all consistent with Oracle Holdings bylaws starting on page 236 of the suppressed record, which state that Oracle Holding must have, not that it may have or can have, it must have an office and a principal place of business at Oracle's headquarters, which are located in California. Now, all of that shows that Oracle Holding has property, 100% of which is in the United States, and it must be included under the Water's Edge statute. Now, if this court were to find that, so I guess to step back for a second. So that's the history and the text of the Water's Edge statute. Now, the next argument, the absurd results statute, the absurd results doctrine, is our argument if this court were to accept Oracle's argument, which is, first of all, it's twofold. First of all, Oracle Holding has no property or payroll. And second of all, because it has no property or payroll, it must be excluded from the combined return. Now, if those two conclusions are accepted, that will lead to several absurd results that must be avoided. The first is that every holding company, based on that theory, would then be excluded from combined reporting in Colorado. And that's something that the General Assembly could never have intended. Because as Oracle states, holding companies are ubiquitous in corporate law. The other absurd result is that it will also lead to the exclusion of every subsidiary of every holding company in America. And that is also an absurd result that the General Assembly could not have intended. I think that the absurd results doctrine is best illustrated through two cases from this court. Mr. Gill mentioned them, the Avicom case and the Frazier case. In Avicom, this court considered the construction of a statute that imposed a requirement on certain telephone providers to pay a certain tariff. And the telephone providers argued that statutory requirement hinged entirely on whether they charged prices based on flat rate or based on usage. And this court found that accepting that interpretation would lead to absurd results because it would make the statutory requirement too easy to circumvent. It would allow companies to choose their own pricing and then circumvent the statutory requirement based on something that's entirely in their control. The same thing is the issue here. If this court finds that holding companies don't have property and payroll and also are excluded because they don't have property and payroll, then any company in the U.S. could choose where in its corporate chain it wants to cut off for a combined return. So that not only that holding company, but also every subsidiary would be cut off, and that statutory requirement would then become too easy to circumvent.
So I guess help me understand why that's crazy. Corporations structure their affairs all the time. They'll have to pay taxes in states where they happen to do business. Why is that so crazy?
Because, Your Honor, the General Assembly intended to adopt a combined reporting statute in Colorado. Otherwise, 3922-303 would not exist.
But it set limits on the percentage of property that you have. It doesn't say every domestic corporation is included no matter what. There's a 20% rule at least to be included if you read it that way.
Sure.
I mean, I guess where I'm heading is, it seems to me, and I understand your argument, I'm just wondering whether your argument is better made to the legislature.
Thank you, Your Honor. And we don't believe so because both in Avicom and in Frazier, if this court had read those statutes under the plain language, then they would not have reached the results they reached in those cases. The purpose of the absurd results doctrine is to get to the intention of the legislature by refusing to apply interpretations that lead to results that the legislature could not have intended. And here, if indeed combined reporting could be avoided simply by placing a holding company at any point in the structure, that would make it would no longer be a statutory requirement at all. Instead, it would be an option that companies would only use when they have losses in subsidiaries, so that they would structure their combined reports so they only include loss companies, and then income companies would be totally excluded, and what we would be is a separate reporting state, not the combined reporting state that the General Assembly intended.
Can I interrupt a minute and ask you just maybe to flesh out and make really clear what you think the absurdity doctrine is, what you mean by absurdity, and where I'm going particularly is, I didn't hear you exactly respond to Justice Gabriel's question to ask what language in the statute you believe is susceptible of a reasonable interpretation your way, and why we should choose that because any other would be absurd.
Thank you, Your Honor. So, yes, I guess there are two questions there. What is the absurd results doctrine, and what language does the department rely on here in the statute? So the absurd results doctrine, so we cite in the case, in our briefs, cases that define absurd under the absurd results doctrine. As I recall, it is a result that is so unnatural or unreasonable that a reasonable person would not have intended it.
And I guess maybe I'll make clear here, because I think cases are unclear, and actually we've argued about this, all of us, since we were in law school. But fundamentally, I'm asking you, are you interpreting the absurdity doctrine here to mean that where a statute is ambiguous and susceptible of a number of reasonable interpretations, we should not choose one that leads to an absurd result? Or are you, and this occurred to me because of the way you used the term plain language a minute ago, or are you saying, although the statute is clear and plain on its face, if it would be absurd, we can reject that meaning? Yes,
Your Honor, and I think why I'm a little confusing is I'm trying to argue both. So if a statute is unambiguous, both Avicom and other cases we cite in the brief say that even when a statute's language is unambiguous, the court will construe the language to avoid absurd results. However, that principle should still apply even if a statute's language is ambiguous, that then one interpretation should be chosen over another to effectuate the legislature's intent and to avoid absurd results. But to get to your question about what in the statutory language we're relying on, specifically it's the percentage requirements, and it's the requirement in subsection 8 that a corporation must conduct business outside the United States in order to be excluded. That the General Assembly intended 8 and 12C to be read together, and that to be read consistently, and that's stated in the legislative history, and that includes the requirement that you must conduct business outside the United States in order to be excluded. Now, what Oracle is arguing is that there's some affirmative requirement to conduct business inside the United States in order to be included, but that's not in the statute. If the General Assembly had intended that, they would have stated something like in 12C that a corporation must conduct business inside the United States in order to be included. That statement does not appear anywhere in statute. Instead, the only requirement is that if you conduct business outside, you must be excluded.
Then what is the role, in your view, of 12C? If subsection 8 essentially encapsulates the water's edge rule, why even have 12C? What purpose does it serve there, and what meaning should we give to it?
The purpose of 12C, Your Honor, is to apply the rule to taxpayers. When the Water's Edge Bill was originally written, as you look through the legislative history, it first only included 8. 12C was added when the bill was before the Senate Finance Committee, which was the second to last step before it was adopted. And at that point, all they say about 12C is that we added 12C to be consistent with 8, to define includable corporations consistent with 8. And this isn't in the legislative record, but what we see, what the department sees from the statute is that if 8 were the only statute in place, then the Water's Edge requirement would only apply to the department, because 8 only refers to the department. It doesn't say anything about taxpayers. It says the department may not include. 12C applies both to the department and taxpayers. 12C was added then to prevent taxpayers from including Water's Edge companies in their returns, which some companies may want to do for loss companies. They might want to include a foreign loss company in their return. So that's how 12C operates.
Mr. Patterson, is your argument that the statute is ambiguous or unambiguous? I'm confused.
Thank you. I can see why. Thank you, Your Honor. So our position is that it's unambiguous. And so when I argue about legislative history, and it's to give context for the context in which the statute was adopted, because it was not just in Colorado. It was a part of a national movement to move away from worldwide combined reporting. But if this court were to find that the statute's ambiguous, then we think it's appropriate to look at that legislative record, which clearly says that only predominantly foreign corporations were meant to be excluded.
So what are you asking for our holding to be?
We are asking for your holding to be that corporations must have foreign property or payroll in order to even be considered for exclusion under the Water's Edge statute.
And where is that unambiguous in the statute?
It's unambiguous in the statute in subsection 8, which says a corporation must conduct business outside the United States in order to be excluded from combined returns. Now, I guess the last point is subsection 6. The court below said that...
Before you move to subsection 6, sorry, can you say a little bit about the 1990 regulation that was allowed to expire and replaced by the 94 regulation?
Yes. The 1990 regulation is not what the department's position is here today. It was much broader than that. The 1990 regulation was specifically designed with foreign sales corporations in mind, and you can see that from the legislative record of that regulation. And that regulation stated that if a corporation functions through property and payroll that's owned by an includable corporation, then it must be included in the combined return. And so what that meant was that a foreign sales corporation or any foreign holding company, as long as it used property and payroll that was owned by the parent company, would be included. And so that could even be 100% foreign property and payroll. That's different from what we're arguing here today, because we are now consistent with the intent of the statute, which is what's the proportion of the company's operations, and where are those operations actually located. Under the old regulation, a company that was entirely foreign, using entirely foreign property and payroll, would have been included, but that is not consistent either with regulation 4.18b2 or consistent with the statute. And I think it's important when looking at the history of that 1990 regulation that a legislator was specifically asked, if we get rid of this regulation, what will it do? What will the impact be? So the legislature was looking at the impact. And the department's representative replied, there won't be that big of an impact. It will only impact companies with these foreign sales corporations. So all that the General Assembly was aware of when addressing the 1990 regulation was the impact on companies with foreign sales corporations, not domestic holding companies everywhere. So lastly, to move to subsection 6.
Before you do that, sorry. On your argument related to Oracle Holding using Oracle's property, it looks like the district court found that the department had made an insufficient showing with respect to that, insufficient at least to raise a genuine issue of material fact. So can you address that?
Yes, Your Honor. And so the facts in this case, this is a summary judgment case, the facts in this case are all undisputed, and it's based, the record cites I gave earlier were based on documents that Oracle has given us and also Oracle's 30B6 deposition testimony. And so it's a mixed question of law and fact. The district court made a decision based on undisputed facts, and that decision is legally incorrect based on the record.
Right, but I'm interested in the specific finding that you didn't make a sufficient showing with respect to property that you're claiming Oracle Holding owns.
Okay, and I think that is contradicted by the record, Your Honor. When you look at page 1335 of the record, you see that Oracle Holding used Oracle's headquarters in California to complete a $6.4 billion loan transaction. When you look at page 61, you see that Oracle Holdings officers and directors used Oracle's system to document every action that the board took. When you look at page 236 of the suppressed record, you see that Oracle Holding must have and maintain an office or principal place of business at Oracle's headquarters. You can't earn $6.4 billion just by using no property or payroll. And here that money was earned by Oracle Holding using Oracle, the parent's property and payroll, all located in the U.S. Lastly, with subsection 6, now the court below referred to taxation as an ongoing cat and mouse game of taxpayers finding loopholes and the legislature closing them. That view of taxation as a game is unfair both to taxpayers and to the department. It's unfair to taxpayers because it prevents the department from applying tax on a fair and equal basis. But the legislature has given the department a tool to avoid that result. That tool is subsection 6, which allows the department to avoid abuse, clearly reflect income, and do so on a fair and impartial basis by allocating income from one corporation to another. Here, the abuse, so there were some questions about how abuse should be defined in the last argument. Abuse is a broad term. It includes definitions such as misuse or to put to a use other than the one that was intended, as well as other definitions like a deceitful act. So it includes both intentional actions that were preconceived from the beginning and also actions that were a misuse of, as we contend, of the statutory scheme. And there was a question about what the guardrail should be about subsection 6. Well, first of all, it's the plain language of abuse. Abuse does have a meaning, and that meaning can be applied both by the department and by the courts. But even more importantly, all taxpayers have due process and Commerce Clause rights. And the ability of states to tax in a combined return is explicitly limited by well-developed case law under the due process and the Commerce Clauses. And that is a guardrail that applies to every taxpayer regardless of what statute is being applied. With that, I'd like to reserve my remaining time for rebuttal. Thank you.
Thank you, Chief Justice Coates, and may it please the court. I'm Neil Pomerantz, and with me is my partner, Mark Bedina, and we represent the respondent, Oracle Corporation and subsidiaries. This case is unquestionably unique. It's a case in which the Department of Revenue argues against its own longstanding and very explicit regulation and tax bulletin. It's a case in which the department advocates for a position that the General Assembly itself has already considered and rejected.
May I interrupt you right there? Because just to pick up with Justice Hart's question earlier, your opponent suggested that for decades now, holding companies have been subjected to combined reporting. Is that your understanding Do you have a comment on that?
Absolutely do, yeah.
Okay.
It's not my understanding. We asked at the district court level in discovery for information about how other taxpayers had been treated. We were told that the department would not provide any information because it was confidential taxpayer information. I happen to be aware of other cases in which taxpayers are taking precisely the same position as Oracle and Agilent.
Why then did Oracle initially include OJH in its combined returns?
I don't think they did, and I will admit that the tax return, the original tax return, is not entirely clear on its face. If you look at page 586 of the record, you'll see that Oracle indicated in the affiliation schedule for each of its affiliates that OJH satisfied only 2 of the 6 tests for combination in subsection 11. So one of Oracle's positions always has been that OJH can't be combined for a number of reasons, including the fact that it failed the 3 of 6 tests for combination, and that's reflected on that page of the record. So there were multiple reasons why Oracle felt that both OJH should not be combined and the gain that's at issue here should not be part of the combined return. And there are multiple explanations that are reflected in that original return. But I would add that in some ways it's beside the point. The law is the law, obviously, and the law prescribes that entities without more than 20% of their property and payroll in the United States, as clearly reflected by the department's regulation, must be excluded from combined reports. This dispute arises from the intersection of 2 sets of events that occurred decades ago, and I want to provide a little context for the issues that have been discussed here today because I think it's very important. And that's the intersection of a critically necessary business transaction for Oracle and a real transformation of Colorado's corporate income tax regime. So let me spend a minute on each. First, the business transaction. In the early 1990s, Oracle faced financial hardship and desperately needed a loan. It was unable to obtain that loan from traditional U.S. banks, but a lender emerged from the Japanese economy, which was very strong at the time, and that lender was Nippon Steel Corporation. And NSC agreed to loan Oracle $80 million, but only on the condition that Oracle create a new company to hold its Japanese subsidiary, Oracle Japan. That new co that was created was OJH. As a further condition for the financing, NSC received the right to purchase up to 20% of the stock of OJH and another 5% of the stock of Oracle Japan. There is no dispute, there has never been any dispute, and both lower courts found that Oracle created OJH for legitimate business purposes that had no tax motivation whatsoever and certainly no intent to avoid or reduce Colorado taxes. And indeed, Oracle presented expert testimony that holding companies like OJH are commonly created for precisely these purposes, to hold assets and to satisfy contractual commitments. 9 years later, 9 years after the creation of OJH, at the height of the dot-com era, OJH was able to monetize the substantial appreciation in the value of its asset by selling a 10% stake in Oracle Japan on the Tokyo Stock Exchange. That sale produced the gain that the department now wishes to tax. And there's no dispute as well that that sale also was executed for legitimate business purposes that were unrelated to any tax motivation. So those are the business transactions that bring us here today. Now I want to spend a minute on the transformation of Colorado's income tax regime. Because just a few years before Oracle created OJH, there was a revolt of sorts that was taking place here in Colorado. Prior to 1985, this court authorized the department to combine related entities into a single income tax return so as to tax all of the income that the state constitutionally can tax. Those were the boundaries at the time. Anything that the Constitution would allow was subject to taxation here in Colorado. That was reflected in the court's 1980 Jocelyn decision, and the methodology that was embraced is called the unitary business model. But the business community raised strong objections on 2 grounds. First, the statutes that existed at the time provided no guidance to taxpayers regarding which of their entities would be considered unitary and therefore would need to participate in a combined return. Taxpayers were often surprised by the department's combination determinations that were made on audit many years after returns were filed. And second, the approach at that time allowed the department to broadly tax income earned anywhere in the world. Our General Assembly proved sympathetic to those concerns. In 1985, it enacted a series of bright-line tests to determine whether any entity, domestic or foreign, could be included in a combined income tax return. And it is really impossible to overstate how unique these limitations were and are. Across the 26 other states that authorize or mandate some form of combined reporting, there is no other state that has anything like Colorado's 3 of 6 test that's reflected in Section 11A, which requires that at least 3 of 6 very specific intercompany tests be satisfied before one entity in a corporate family may be combined with its affiliates. No other state has Colorado's 2-year rule, which prohibits the combination of any entity until the 3rd consecutive year the 3 of 6 test is satisfied. And no other state mandates the exclusion of income and entities from combined reports based both on the level of its property and payroll outside the United States and on the level of its property and payroll inside the United States. The legislature was well aware that these tests would limit the membership in combined groups in all sorts of ways by excluding both domestic and foreign entities. But this compromise served the General Assembly's paramount goal, which was objectivity and predictability in the formation of combined groups. That 1985 legislation was not the end of that effort. That's because in 1988, in this court's Hewlett-Packard decision, the court suggested that notwithstanding the new statutory tests, subsection 5 of Section 303, which is now subsection 6, still might be used as a tool to alter combined groups. And the General Assembly wanted a different result. In 1989, in the very next legislative session, it enacted additional legislation to further restrict the department's ability to make combination determinations on an ad hoc basis. 1989 House Bill 1164 curtailed the department's discretion in 3 additional ways. First, it added the avoid abuse requirement to subsection 6. And it even had the department's executive director state on the record his understanding that Hewlett-Packard no longer applied, that the department would no longer use Hewlett-Packard to alter combined groups as they were determined by the statutes. Second, the 1989 bill mandated within the combined reporting statute itself, within Section 303, that the Department of Revenue promulgate regulations informing taxpayers how it intended to apply the statutory combination tests. That's now found in subsection 13 of 303. And what the legislature was saying is that to the extent there are any gaps or uncertainties that are left in the statutory language, the department should fill those gaps. In fact, it was mandated to fill those gaps with formal public regulations. And third, to reinforce that obligation, the legislature added what is now Section 310, 3922-310, which states that a formal public regulation is entitled to deference, but a department interpretation that is not supported by a formal regulation is entitled to no deference whatsoever. All of these statutory changes in 1985 and then again in 1989 reflect the General Assembly's determination to bring objectivity and predictability to the formation of combined groups. The General Assembly was insistent that combination should be based solely on the statutory tests and the department's formal public regulations. It didn't want combination to be left to subjective, unwritten determinations made by the department on audit years after returns were filed. So with that as context, I'd like to turn to the statutory language. Section 303.12c establishes one of the thresholds to be eligible for inclusion in a combined return. And let me maybe pause here to address a number of the questions that have been asked earlier, which is how 12c relates to 11. Subsection 11 prescribes the 3 of 6 test and the 2-year rule for combination. But before you get to those tests, it says that to be included in a combined report, you must be a member of an affiliated group. Or rather, it says that the 3 of 6 test and the 2-year rule only apply to affiliated groups. So to determine which entities are in the affiliated group, you need to look first to 12A. 12A begins the definition of an affiliated group, and it talks about one or more chains of includable C corporations. But then you have to figure out what an includable C corporation is. And to get that definition, you have to go to 12C. So 12A and 12C together establish which are the members of an affiliated group, and therefore, which are the entities that are even eligible to sit for the 3 of 6 test and the 2-year rule. If you don't pass the 12C definition, you don't even get to the tests in 11A.
And so where does subsection 8 fit into that scheme?
So I think 11 and 12 should be read as a unit. Those are the statutes that define the membership in a combined group. They talk about which entities, which C corporations are included in the combined group. Subsection 8 talks about income. And I think what it says is that after you form the combined group in 11 and 12, if there is otherwise any income that finds its way into the combined group, perhaps it's through some kind of distribution, that comes from an entity that meets the test in subpart 8, that income needs to be excluded from the combined report. And the executive director cannot include that income in the combined report.
So I think I understood, and thank you for clarifying. I think I now understand where I may be headed in the wrong direction. Under your analysis on 11 and 12, Oracle and Oracle Holdings, that kind of chain would not be included here.
That's correct. So that would break the chain, and so OJH, Oracle Japan Holdings, would not be part of an affiliated group, and therefore wouldn't be part of the
All
combined
right, so we're defining the affiliate group here as each particular chain, as opposed to, I think what I was thinking was parent, and there's a whole bunch of affiliated groups. So the
right.
Oracle OJH sub is an affiliated group that your argument is not includable for the reasons you've discussed.
That's right. There is an affiliated group here. It includes other chains within the Oracle corporate family. It just doesn't include OJH because OJH doesn't satisfy 12C.
So that chain would not be required to be
included.
included. Okay, thank you.
That doesn't mean that, as I think the court is aware, that OJH or even subsidiaries of OJH could not be included in a separate tax return to the state of Colorado if, in fact, they were doing business here. That happens not to be the case here because OJH's only subsidiary was Oracle Japan, which operated exclusively in Japan, and there's no dispute that that entity was properly excluded from the combined report.
So on your analysis, if we were to ask you, my friend Justice Boatwright's favorite question on what should our holding be, from where you sit, are we done at 11 and 12? We don't have to reach 8?
That's right.
Okay.
That's right. That's exactly correct, that because OJH is not an includable C corporation, because it doesn't have more than 20% of its property and payroll inside the United States, it can't be included in a combined report. End of story. And just to return to the statutory language and to questions I think, Justice Gabriel, that you asked earlier, I think it's absolutely correct that an entity without any property and payroll of its own cannot satisfy that requirement, because that requirement asks whether you have more than 20% inside the United States. It requires some affirmative showing of property and payroll inside the United States. In the same way, you might look at 8 and say that requires a showing of property and payroll outside the United States. There's two different tests. They're consistent. They're trying to accomplish the same goal, which is to identify income that is likely earned from a foreign source, but they're looking at the problem from two different directions. One is an outward-looking test, subsection 8, and subsection 12 is in some ways a corollary of that. It looks inward to determine whether there is some meaningful and measurable United States presence as measured by its property and payroll.
Counsel, do you agree with the Department of Revenue's argument that under this interpretation, any corporation that might be subject to taxation in Colorado can exclude its subsidiaries' income by inserting a holding company in between itself and its subsidiaries?
Okay, so let me answer that in two different ways. As a technical matter, that wouldn't always answer the question because the subsidiary still might have an independent obligation to file a tax return. And in fact, the department takes the position often that there are entities that have assets, for example, from intellectual property that may not be includable in a combined report, but still have an independent obligation to file a separate return. So that's part of the answer. The other part is, if there is truly an abusive situation going on here, and that's not the facts of this case, but if there were truly, for example, an entity that said, hey, I want to make a sale of an asset and it's going to earn a big gain that would otherwise be subject to Colorado tax, I want to avoid that. So, the day before they set up a holding company for the sole purpose of avoiding that tax. There are all sorts of tools that are available to address that situation. There are many common law tools, for example, that were identified by this court in the decision that was issued yesterday. There are tools that could be applied to address that type of situation. That just isn't the case here. And moreover, I would say, as I think it was the Court of Appeals recognized, the department hasn't made any showing that that happens with any regularity. Right? There's no evidence in the record that even apart from Oracle, that type of situation is happening. And if there really is a general problem here, if taxpayers are trying to circumvent Colorado tax by misusing any of these provisions of law, they should go to the legislature. The department should go to the legislature and seek a statutory fix.
A quick follow-up on that train of thought. Included in that toolbox, would you put subsection 6?
I think subsection 6 is a tool. It just isn't designed for this type of situation. Subsection 6, by its terms, refers to a reallocation of income and deductions. What it's really talking about is an intercompany transaction that's been mispriced, that's been artificially priced in a way that doesn't reflect true market conditions.
And you're basing that interpretation because of the regulation shedding light on that, or?
Both the regulation and the statute. And from looking at the statute, because it's looking at income and deductions, I think those are critical words. Those are two sides of a transaction. One party recognizes income, the other party recognizes the deduction. And so in order to make sure that one party doesn't artificially lower the income that would be taxable, or that another party artificially increase the expense deduction so as to reduce their tax, the department can come in if there's been a mispricing and reprice it to reflect true market conditions. And that's reflected also in the regulation, which refers to Section 482 of the Internal Revenue Code as an example. Section 482 is a transfer pricing mechanism that's aimed at addressing mispriced transactions between controlled corporations. Right? But we don't have that here because we don't have a transaction between controlled corporations. All we have is a sale of stock by OJH. There was no transaction, much less one that was priced in a non-market manner. But there are other tools. Economic substance might be a tool. Substance over form. In the proper situation where the facts warrant it. That just isn't the case here. OJH was created 9 years before this transaction took place for reasons that have nothing to do with tax. I want to spend a minute just talking about the differences between subsection 8 and subsection 12C. I think 12C can really just be read by its own plain terms, and it clearly doesn't apply or it doesn't include OJH. But I also think it's significant as you look at those two statutes to recognize that there are a number of differences in the language between the two. So one is the obvious difference that we've been looking at. Subsection 8 looks at property and payroll outside the United States. Subsection 12C looks at property and payroll inside the United States. There's also the difference that the Court of Appeals, as well as I believe the District Court, acknowledged that subsection 8 requires that an entity conduct business outside the United States. Subsection 12C doesn't have that language. As this Court has said in the well augmentation case, when the legislature uses words in one provision and excludes it from others, we assume that exclusion was purposeful. In the Romer case decided by the court went even further to note that when language appears in one statutory provision but not in another, We don't assume that's an error or an omission, but rather we assume that that's a statement of legislative intent, that they intended to do something different. So that's the second difference. The third difference, as I mentioned a moment ago, subsection 8 refers to income that must be excluded from a combined report. Subsection 12C is talking about entities, which entities are eligible for inclusion in a combined report. And subsection 8 directs its command to the executive director, to the department, whereas 12C is addressed more universally. So there are all these differences that I think are too numerous and too significant to ignore. And I think that's further reason just to interpret and apply 12C by its own plain terms, which I think lead to an inescapable conclusion.
Mr. Pomerantz, can you, I'm just been thinking, is there a situation where you would have to reach both 12C and 8? In this case, you say, we're done at 11 and 12, our analysis. And I'm trying to think of, I understood all the distinctions you just said. Is there a circumstance where a court would have to reach both? I mean, I'm trying to figure out how nonetheless 12C becomes superfluous or 8 becomes superfluous under your argument.
Yeah, 8, well, let me answer the more obvious one first, which is that 12C needs to be addressed in situations like we have here, where you have an entity without property and payroll. That's at least one situation in which 12C would need to be addressed. Subsection 8, I think, is the situation that I referred to earlier, which is where you formed a combined group of entities, but somehow otherwise income that was initially earned by an entity that was excluded from the combined group, say under 12C, otherwise has found its way into the combined report. And that's where 8 might say that income, because it arose from an entity that has 80% or more of its property and payroll outside the United States, still must be excluded.
Thank you.
How would that income find its way into a combined report?
You know, it could be a distribution. Perhaps it's a dividend from an entity that's excluded to an entity that's included. You might even read 8 as a limitation on subpart 6, which also refers to income, as a limitation on when subsection 6 should be included to address transfers of income between entities. I'd like to spend a few minutes on subsection 6, which I think in this case the department is attempting to use as a backdoor to try to bring into a combined report income that would be excluded under the combination tests. I referred earlier in my remarks to the legislative changes in 1989, which were intended to address the Hewlett-Packard decision. And those were the changes which added the avoid abuse requirement to subsection 6. And I think it's significant that in that discussion of those changes, it was so important to the legislature that subsection 6 not be used as a tool to circumvent the clear objective tests that they had put into the law, that they had the department's executive director come and recognize that fact, to recognize that it was the statutory tests, particularly in subsection 11, that would govern whether or not an entity is includable in the combined report. And that, as was mentioned in the prior argument, is clearly reflected in the department's regulation that followed, the regulation 303.6, which begins by saying and acknowledging that subsection 6 has now been superseded by subsection 11 as a vehicle for combined reporting. So subsection 6 is just not the appropriate tool for combination. It's really a tool, as I was mentioning, for reallocating income and deductions associated with an intercompany transaction. But in addition, subsection 6 has a further limitation, and that's the limitation that it can only be invoked where necessary to avoid abuse. And the department's executive director, again, recognized on the record that that requires purposeful bad conduct by the taxpayer. It's to go after the bad guys, he said. It's not to be invoked where there's a legitimate business reason for the transaction. And that's directly contrary to the department's interpretation of that phrase in this litigation, where the department is suggesting that abuse is, frankly, whatever they deem it to be on a case-by-case basis. Abuse is whatever the department views to be inconsistent with what the legislature would have intended or should have intended. And I would state even further that the department's interpretation of abuse really would bring us back to the regime we had before any of these statutory changes were made, before 1985, because the department, under their interpretation of subsection 6, could invoke it pretty much at will on a case-by-case basis to bring all sorts of entities into a combined report. In our case, all of the record evidence indicates that there was absolutely no abuse. There was no abuse in the formation of OJH. It was, as I mentioned, formed for reasons unrelated to tax because the company desperately needed a loan. It was, throughout its existence, operated without any tax avoidance motivations. And this subject stock sale in the year 2000 took place without any tax-related considerations. So there was no abuse. Under any plain and ordinary definition of that term, there was no abuse here. If the department believes that that is not the right standard, that they should have greater discretion to alter combined groups, notwithstanding the statutory tests, again, the proper forum for that request is the General Assembly. It's not this court. So I think that's all that I have. I'd be happy to answer any further questions.
You think if the Court of Appeals opinion were to be upheld, companies coming in to then structure their affairs to insert holding companies, would that be kosher? Would that be abuse? Would that be, I'm just trying to think about the impact as a practical matter and think about the concerns raised by the department.
And let me answer by starting with the point that your question is really even broader, because there are all sorts of limitations on combination in these statutory tests. One that we haven't really talked about is the 2-year rule. Any entity in the first 2 years of its existence can't be combined. And so when the department on audit looks at a large corporate family, the first thing they do is they just cross out every entity that is in its first 2 years of existence and exclude those from the combined report. These types of actions by a taxpayer and effects on what the membership is in a combined group arise from all of these different combination tests that are in the statute. And I think for each and every one of them, the question has to be asked whether the company was acting in a way that demonstrates a legitimate business purpose, that there was a reason for their conduct, that their conduct wasn't solely related to tax avoidance, an interest in avoiding tax. And if an entity was created solely for tax considerations, solely to avoid bringing income into the combined report or otherwise allowing it to be subject to tax, there are those tools that are available. But that's a question across the board in Colorado's regime. But again, that was a choice that the legislature made for very valid reasons, I think. They wanted objectivity, and they wanted predictability, and they wanted accountability from the Department of Revenue, and they recognized that would, in many cases, limit the membership in combined reports.
Can I ask a question? Several times you said something was a question of going back to the legislature, and I appreciate that generally in terms of rewriting the statute. Should it have any effect on how we construe the legislation, that the legislature might not be able to change tax policy in such a way without a vote of the people generally?
I don't think it should affect the way this court views the law as it was written in 1985 and 1989. Thank you very much.
May it please the court. Just a few points on rebuttal. First off, I'd like to start with the impact of this case. Opposing counsel stated that there are many bright line requirements in a combined reporting that could be similarly lead to similar results. But this requirement is unique because of, first of all, how widespread it already is. As Oracle says, holding companies are ubiquitous in corporate law. So thousands or hundreds of thousands of these already exist, that the day that, if the court below, if their ruling is affirmed, the day that that is affirmed here, all of those, the hundreds of thousands of holding companies would automatically be excluded from combined returns as well as their subsidiaries. So it's unique in that way. It's also unique in how easy it is to form holding companies. It does not require any really any act of economic import to form a holding company. You're filing a paper with the Secretary of State and putting some asset in it in exchange for stock. That any company can do at the drop of a hat. Opposing counsel began his testimony, or his argument by stating that, giving the history of Oracle Holdings' creation in connection with the Nippon Steel transaction. That transaction ended before the years at issue. It is not relevant to our case here. What is relevant is that the Oracle Holding 30B6 deponent testified on pages 73 and 74 of the record that the reasons for the existence of Oracle Holding during our years at issue were two. They were that it was a quote-unquote functioning holding company, and second, that it had a loan with another Oracle subsidiary. Those are the only reasons that we have been given for Oracle's existence during the years at issue, Oracle Holdings' existence during the years at issue. The third point I'd like to make is that subsection 12C is not unique. There are two other states that have a statute like 12C that require more than 20% of property and payroll inside the U.S. to be included in the combined return. Those are North Dakota and Alaska, and you can see that by looking at the statutes referred to, the statutes referred to in the Schlumberger and the Amarada Hess cases in the briefing. So Oracle Holding does not dispute in closing that its reasoning would allow any company to avoid combined reporting, and we ask that this court reverse the decision below to prevent that from happening. Thank you.
Thank you very much. We appreciate the arguments of both counsel. The case will stand submitted, and the court will be in recess until 1 o'clock.
Court is in recess until 1 o'clock.